Scores of South African businesses are suffering from mounting debt in the current economic environment. Analysts are highlighting that business conditions are worsened by rising interest rates, high inflation and the effects of power outages. Ramone Pillay from Debtsource speaks to us about this. Thank you so much and welcome to the AM report, Ramone. Let's first try to paint a picture of what exactly the current business climate looks like and what Debtsource has found about the performance of companies between the 6 and 12-month period.
Tumusang, thank you for having me on your show, and thanks for your listeners for listening in. So over the past 6 to 12 months, we've seen lots of animosity in the market, high inflation rates, interest rates, lots of load shedding, and this has contributed largely towards the way in which businesses operate within our market. It's affected a lot of the manufacturing sectors and the retail sectors as well because of operations. So what we've noticed is that each time we found that there was a 0.25% increase in our interest rate, it ultimately provided claims through to credit insurers, which just made the market a hell of a lot more difficult to operate within. Because when you start to get claims, we obviously know that in some instances from a credit insurer's perspective, it becomes a lot more difficult to insure further debt. So painting a picture from businesses and operationally, it makes it a lot more difficult for them to operate each time this increase from an interest rate takes place. From a debt source component, what we've allowed businesses to try and emulate is to get more information on their customers and their debtors. We've seen that a lot of businesses find it very difficult to pay their debt off because their customers haven't paid them. So their creditors don't get paid on time because their debtors haven't paid them. So Debtsource assisted with a lot of information, customers sending through their collections a lot earlier, their legal collections. We would assist them with collecting that much earlier so that businesses could operate a lot easier through these tough economic times. Another challenge that we found throughout businesses was where businesses did not have a lot of insurance in place. So we had come in, we had done an analysis within companies, and we had placed in credit insurance policies. And these credit insurance policies saved a lot of businesses through tough times. We call it protracted defaults, which merely means that a client decides either not to pay for various reasons. And that's where credit insurance policies pay out anywhere between 70 to 85% of the outstanding debt, and businesses were saved through those tough economic times of whatever the balance was outstanding that was owed to them.
Interesting developments, and the dynamics are changing there within this space. But coming to the insurance part of it, the service offerings currently, are they conducive for the type of businesses in South Africa? I ask because some of the smaller entities may not be able to even afford the likes or qualify for the likes of this credit insurance you speak of.
So, Tumusang, they're absolutely conducive for our South African market. In fact, within our South African market, it's actually quite amazing that we price it so well. So insurance within the South African market is priced really well at this point in time, making it really affordable for lots of businesses. From an insurer perspective, it makes it pretty difficult when there are claims because the premium income versus the claim ratio, it doesn't really weigh out. And that's one of the reasons why we find a lot of insurers do become quite reserved from a credit insurance perspective. From a commercial point and from a business perspective, we've got various options that are available for clients which do become very conducive. So we have something called comprehensive credit insurance, which allows a client to cover their whole book. And then we have selected data insurance, which allows clients to selectively insure their book. So for smaller businesses, the selected data insurance model works absolutely brilliant. For your larger corporates or SMEs, or for businesses that have lots of debtors with lower values, the comprehensive model would be the best option for them. In some instances, we find that there's a combination of the two, where some customers have a bit of a comprehensive policy And if that insurer decides that there's too much of risk for them, they decide to selectively insure through an additional credit insurer. So it's absolutely conducive for our South African market at this point from a pricing component as well.
Ramone, given that the near-term outlook in South Africa's economic trajectory is not going to change with the magic wand, meaning it's not going to take place tomorrow, what's to be said about the expectation on the side of the survival of businesses under the tough economic times that we find ourselves in?
So, Tumisang, my recommendation to businesses throughout the survival period would certainly be to focus a lot on their debtors book. The reason why at Debtsource we focus a lot on debtors book is because that is a business's cash flow. And it speaks to how a business would either, one, be able to access additional funding, or two, where that business is actually heading from a cash flow perspective. Second option would be is to protect future business. So we would look at protecting future business through either self-insurance models that we've put in place, credit insurance models, but most importantly doing credit assessments on new customers, as well as existing customers. So this means that we need to understand the type of debtor that we're dealing with before we actually take them on our book. It's all well and good that we get the sale, but it's a whole different story about getting the money in the bank. And that's the tough part for consumers as well as businesses to understand that concept of, one, we get the sale and we get extremely excited, and then the opposite side as well, actually, do we get paid? And the payment component is really important. So taking both those into account, we need to assess which is the perfect debtor for us. So my recommendation, make sure that we're focusing on our debtors book. Second option is make sure that we protect our age analysis or our debtors book. Some of the options that we would consider, and the ideal DSO, and DSO stands for Daily Sales Outstanding, we look at a period of 45 days. And what does that mean? It means that if our client takes longer than 45 days to pay us, then we need to get a little bit more concerned than we would in an environment where a client takes 40 days to pay us. So at Debtsource, we start to use those sorts of indicators as a clear understanding as to whether a client's going to pay us on time or not.
Thank you for your contribution. That is Ramone Pillay from Debtsource talking to us about the current debt burden facing businesses in the country.